Called 2009 the year of recovery for investors. Since its March low, the stock market, we're looking at the Dow here, has made an incredible comeback. But the question so many of you have, I have, we all have, is how long will that last? So let's bring in our good friend, Doug Flynn. He's a certified financial planner with Flynn Zito Capital Management, a good friend of our show. Doug, good to see you.
Hi, Doug.
Good to see you. Hi.
Answer our question. How long will that last?
Well, it will definitely last for a couple of months, possibly half the year this year. And the primary reason is because everything is still in place that was in place from the end of '09, which is the stimulus money, the government buying the mortgage-backed bonds. They've spent a $1.25 trillion on that.
Right.
But that's going to start to end. They're going to stop buying those. The Fed's going to have to raise rates. And you'll hear that in their speaking when they stop mentioning that they're going to keep rates low for an extended period of time.
Right. So we know that whenever we talk about portfolios, you have to have some sense of what your pie chart or portfolio looks like, and I like to always tell people they can go to that one that you and I designed at cnnmoney.com/Alley, and you can ask yourself a few questions, and it'll give you...
portfolio named after you.
I have a portfolio named after me. You answer a few questions, and it spits out a pie chart that represents what you have. And typically speaking, there are a number of categories, but the large ones are bonds, stocks, and alternatives.
Exactly. And this whole thing we're talking about today is not getting away from the allocation. That's important. But within each piece, do you do the same thing you did in '09 that you will do into 2010 and 11?
So you may have a portfolio that's a third, and I'm just making that up, in bonds, a third in stocks, and a third in alternatives. You're not saying that unless your needs have changed, you don't have to change your allocation. But within bonds, for instance, let's start with bonds. Within bonds, what should you do now in 2010?
Okay, so everybody hears when interest rates go up, bonds are not the place to be. Aren't bonds bad is a question I get a lot. And what we're often talking about there in that discussion is treasury bonds do not do well. But what you have to do is you have to look into your portfolio and say, I know I need bonds, but do I have the right kinds? Well, the kinds of bonds that do well in a rising rate environment are not treasury bonds. They're inflation-protected bonds, they're global government bonds, but you want to hedge them. You want to have hedged ones. It's very important because you don't want them to be sensitive to currency. And floating rate bonds, those do exceptionally well in a rising rate environment. So if we're going into that, and we all agree, look at the bond piece of your portfolio. It doesn't have to be changed in percentage, but look at what you're doing within the bonds. And we're talking about taking profits. Take the profits off of all the bond money and the stock money that you've made this year.
Stocks, small cap, emerging markets, cyclical. If you have those, it's time to start thinking large cap growth, U.S. Dividends. They've been cutting dividends. I mean, dividends, the S&P isn't as dividend rich as it used to be, and defensive stocks.
Yeah, if you break down the S&P into high quality stocks, average quality and low quality, and you look at the run that we've just had, the high quality stocks have actually a 0 to negative return. The low quality stocks have gone up over 100%.
Right.
When you put it all together, you get the numbers you get. But when you look deeper, you say it's the higher quality ones that have not participated. Everybody chased the low quality because that's what people do after they lose money. They try to make it back quick. But as we cycle over to higher quality, this is the time. If you invested a year ago, sometime this year, you'll cross over 12 months. Long-term capital gains. We're looking to take profits middle of the year, listen for the Fed when they're going to start to raise rates, and start cycling over to these higher quality dividend, more U.S.-based. Dollar going up is not necessarily as good for the international markets.
And finally, let's talk about alternatives. Some people have had gold, some people have had commodities in there. You're saying that those commodities have been on quite a run for quite some time, and you're saying do something else for your alternative part of this. Go into long, short, which means one industry against another, one company against another, or market neutral. These are mutual funds you're talking about.
They are. And in all cases, people love commodities. If they're not there, they're still chasing them. And we continue to believe they'll do well while we're still in the same 2009 environment. But as that wanes, and again, as the dollar rises, gold, all of these other commodities in your alternative space are not going to give you the same kind of growth that you had in 2010.
Always good to have you here, Doug, because this is a question that's very commonly asked of us. What's going to happen to the market in 2010? And when Christine and I are actually able to answer that question, we're going to be doing this show from our yacht.
Our yacht that's right outside of our big private island.
That's exactly right.
Half of it's his, half of it's mine. All right. Your state may be struggling financially, but most politicians won't even speak of raising your taxes. Instead, surprise, you may be bearing the brunt of the state budget shortfalls without even knowing it.